Basic of algorithmic trading concepts and examples. Algorithmic trading, also called automated trading, black box trading, or algo trading, uses a computer program that follows a defined set of instructions, an algorithm, to place a trade. The trade in theory can generate profits at a speed and frequency that is impossible for a human trader. The defined sets of instructions are based on timing, price, quantity, or any mathematical model. Apart from profit opportunities for trader, algo trading renders markets more liquid and trading more systematic by ruling out impact of human emotions on trading activities. Key takeaways. Algorithmic trading combines computer programming and financial markets to execute trades at a precise moment. Algorithmic trading attempts to strip emotions out of trades, ensures the most efficient execution of a trade, places order instantaneously, and may lower trading fees. Common trading strategies include trend following strategies, arbitrage opportunities, and index fund rebalancing. Algorithmic trading is also executed based on trading volume, volume weighted average price, or passage of time, time weighted average price. To get started with algorithmic trading, you must have a computer access, network access, financial market knowledge, and coding capabilities. Algorithmic trading in Suppose a trader follows these simple trade criteria. Buy 50 shares of a stock when its 50-day moving average goes above the 200-day moving average. A moving average is an average of past data points that smooths out day-to-day price fluctuations and thereby identifies trends. Sell shares of stocks when its 50-day moving average goes below the 200-day moving average. Using these two simple instructions, a computer program will automatically monitor the stock price and the moving average indicators and place the buy and sell orders when the defined conditions are met. The trade no longer needs to monitor live prices and graphs or put in orders manually. The algorithmic trading system does this automatically by correctly identifying the trading opportunity. Benefits of algorithmic trading. Algo trading provides the following benefits. Traders are executed at the best possible prices. Trade orders placements is instant and accurate. That is a high chance of execution at the desired levels. Trades are timed correctly and instantaneously to avoid significant price changes. Reduce transaction costs. Simultaneously automated checks on multiple market conditions. Reduce risk of manual errors when placing trades. Algo trading can be back tested using available historical and real-time data to see if it's a viable trading strategy. Reduce the possibility of mistakes by human traders based on emotion and psychological factors. Most algo trading today is high frequency trading, HFT, which attempts to capitalize on placing a large number of orders at a rapid speed across multiple markets and multiple decision parameters based on pre-programmed instruction. Trading is used in many forms of trading and investment activities, including mid to long term investors to the buy side firms, pension funds, mutual funds, insurance companies use algo trading to purchase stocks in large quantities when they do not want to influence stock prices with discrete large volume investments. Short-term traders and sell-side participant market makers such as brokerage houses, speculators, and arbitrage benefit from automated trade execution. In addition, algo trading aids in creating sufficient liquidity for sellers in the market. Systematic traders, trend following hedge funds, or pair traders, a market neutral trading strategy that matches a long position with a short position in a pair of highly correlated instruments such as two stocks, exchange traded funds, ETFs, or currency, find it much more efficient to program their trading rules and let the program trade automatically. Algorithmic trading provides a more systematic approach to active trading than methods based on trader intuition or instinct. Algorithmic trading strategy. Any strategy for algorithmic trading requires an identified opportunity that is profitable in terms of improved earnings or cost reduction. The following are common trading strategies used in algo trading. Trend following strategies. The most common algorithmic trading strategies follow trends in moving averages, channel breakouts, price level movements, and related technical indicators. These are the easiest and simple strategies to implement through algorithmic trading because these strategies do not involve making any predictions or price forecasts. Traders are initiated based on the occurrence of desirable trends, which are easy and straightforward to implement through algorithms without getting into complexity of predictive analysis. using a 50 and 200-day moving average is a popular trend following strategy. Arbitrage opportunities. Buying a dual listed stock at a lower price in one market, simultaneously selling it at a higher price in another market, offers the price differential as a risk-free profit or arbitrage. The same operation can be replicated for stock versus futures instruments, as price differentials do not exist from time to time. Implementing an algorithm to identify such price differentials and placing the orders efficiently allows profitable index fund rebalancing. Index funds have defined periods of rebalancing to bring their holdings to par with their respective benchmark indices. This creates profitable opportunities for algorithmic traders who capitalize on expected trades that offer 20 to 80 basis point profits depending on the number of stocks in the index fund just before an index rebalancing. Such trades are initiated via algorithmic trading system for timely execution and best prices. Algorithmic trading allows traders to perform high-frequency trades. The speed of high-frequency trades used to measure to milliseconds. Today they may be measured in milliseconds or nanoseconds, billionths of a second. Mathematical model-based strategies. Proven mathematical models like the delta neutral trading strategy allows trading on a combination of options and the underlying security. Delta neutral is a portfolio strategy consisting of multiple positions with offsetting positive and negative deltas, a ratio comparing the change in the price of an asset, usually marketable securities, to a corresponding change in the price of its derivative, so the overall delta of the asset in question totals zero. Trading range, mean reversion. Mean reversion strategy is based on the concept that the high and low price of an asset are a temporary phenomenon that revert to the mean value, average value, periodically identifying and defining a price range and implementing an algorithm based on it allows trades to be placed automatically when the price of the asset breaks in and out of its defined range. Volume weighted average price, VWAP. Volume weighted average price strategy breaks up large orders and releases dynamic, determine smaller chunks of the order to the market using stock specific historical volume profiles. The aim is to execute the order close to the volume weighted average price, VWAP. Time weighted average, TWAP. Time weighted average price strategy breaks up a large order and releases dynamic, determine smaller chunks of the order to the market using evenly divided time slots between a start and end time. The aim is to execute the order close to the average price between the start and the end times, thereby minimizing market impact. Percentage of volume, POV. Until the trade orders is fully filled, the algorithm continues sending partial orders according to defined participation ratio and according to the volume traded in the markets. The related step strategy sends orders at a user-defined percentage of market volumes, increases or decreases this participation rate when the stock prices reaches user-defined levels. Implementation shortfall. The implementation shortfall strategy aims at minimizing the execution cost of an order by trading off the real-time market, thereby saving on the cost of the order and benefiting from the opportunity cost of delayed execution. The strategy will increase the targeted participation rate when the stock price moves favorably and decrease it when the stock price moves adversely. Beyond the usual trading algorithm, there are a few special classes of algorithms that attempt to identify happenings on the other side. The sniffing algorithms used, for example, by a sell-side market maker have built-in intelligence to identify the existence of any algorithms on the buy side of a large order. Such detection through algorithms will help the market identify large order opportunities and enable them to benefit by filling the orders at a higher price. This is sometimes identified as a high-tech front-running. Generally, the practice of front-running can be considered illegal depending on the circumstances, and it's heavily regulated by the Financial Industry Regulatory Authority. A 2018 study by the Securities and Exchange Commission noted that the electronic trading, algorithmic trading are both widespread and integral to the operation of our capital markets. Technical requirements for algorithmic trading. Implementing algorithm using a computer program is the final component of algorithmic trading, accompanied by backtesting, trying out the algorithm on historical periods of past stock market performance to see if using it would have been profitable. The challenge is to transform an identified strategy to an integrated computerized process that has access to a trading account for placing orders. The following are the requirements for algorithmic trading. computer programming knowledge, the program that required trading strategy, hired programs, or pre-made trading software. Network connectivity and access to trading platforms to place orders. Access to market data feeds that will be monitored by the algorithm for opportunities to place orders. The ability and infrastructure to back test the system once it's built before it goes live on the market. Available historical data for back testing depends on the complexity of rules implemented in. If there is large enough price discrepancy to discontinue the brokerage house cost leading to a profitable opportunity, then the program should place the buy order on a lower price exchange and sell the order on a higher price exchange. If the orders are executed as desired, the arbitrage profit will follow. Simple and easy. However, the practice of algorithmic trading is not that simple to maintain and execute. Remember, if one investor can place an algo-generated trade, so can the other participants. Consequently, price fluctuates in milli and even microseconds. In the above example, what happens if a buy trade is executed but the sell trade does not become the sell price change by that time? The order hits the market. The trader will be left with an open position, making the arbitrage strategy worthless. There are additional risks and challenges such as system failures, risk, network connectivity errors, time lags between trade orders and execution, and most important of all, imperfect algorithms. The more complex an algorithm, the more stigma backtesting is needed before it is put into action. Is algorithmic trading legal? Yes, algorithmic trading is legal. There are no rules or laws limit the use of trading algorithms. Some investors may contest that this type of trading creates an unfair trading environment that adversely impacts markets. However, there's nothing illegal about it. How do I learn algorithmic trading? Algorithmic trading relies on quantitative analysis or quantitative modeling. As you'll be investing in the stock market, you'll need training knowledge or experience with financial markets. Last, as algorithmic trading often relies on technology and computers, you'll likely rely on coding or programming background. What programming language do algorithmic traders use? Because it's highly effective in processing high volume of data, C++ is a popular program choice among algorithmic traders. However, C or C++ are both more complex and difficult language, so finance professionals looking entry into programming may be better suited transitioning to a more manageable language such as Python. The bottom line, algorithmic trading brings together computer software and financial markets to open and close trades based on programming code. Investors and traders can set when they want trades open or closed. They can also leverage computing power to perform high frequency trading. With a variety of strategy traders can use, algorithmic trading is prevalent in the financial markets today. To get started, get prepared with computer hardware, programming skills, and financial marketing experience. You know the catchphrase: study it, analyze it, and adapt it. Peace.